Australia's closed border as a COVID-19 defense is starting to have an inflationary effect on the economy as an acute shortage of skilled labor drives costs up and production down. Mining companies in particular are feeling the squeeze, with a growing line of producers reporting cutbacks in output thanks to a shortage of workers, with even those with the most basic skills, such as truck driving. St Barbara, one of Australia's biggest gold miners, is the latest to report operational challenges caused by a shortage of workers. The result is that the company's major asset in Australia, the Gwalia mine at Leonora, is expected to produce at least 15,000 fewer ounces of gold in the year, which ends on June 30 at an additional cost of more than $150 per ounce. Investors were quick to sell St Barbara shares after the release of that guidance update on Tuesday, triggering a 14% fall in the company's share price, even as the price of gold added $20 per ounce to $1,867 per ounce. St Barbara said in a statement to the Australian Stock Exchange that part of the problem with costs and a reduced production expectation was a slower than predicted changeover in a key mine services contractor and slow recruitment of experienced mine operators. Less gold at a higher cost. Guidance for financial 2021 is now forecast to be between 150,000 ounces and minus 160,000 ounces of gold, previously 175,000 ounces, with the all-in sustaining cost, AISC, between $1,412 per ounce and $1,517 per ounce, previously between $1,237 and $1,268 per ounce. St Barbara is not alone in being hit by the labor shortage and rising costs. Big iron ore miner, Rio Tinto, has reported a shortage of skilled workers to handle routine equipment maintenance, and Fortescue Metals has seen work on a new project delayed because of difficulties in flying workers in from other states to its operations in Western Australia. The impact on profits is particularly severe on contractors who lack access to high commodity prices, which are helping the miners weather the storm of rising costs. Last week, Perenti Global, one of the world's biggest mineral exploration drilling companies, reported an encouraging increase in new work but a potentially lower profit than previously expected. Perenti's chief executive, Mark Norwell, said ongoing tightness of the Australian labour market was impacting business margins. Earlier the month, the US-based specialty chemical making company, Albemarle, described labour market conditions in Western Australia, where it is developing lithium processing assets, as being in a crisis. Competition for skilled labour and equipment from other mining companies, especially those riding a record-high iron ore price, is delaying Albemarle's project development plans despite it having sold out of lithium for the rest of the year. The labor shortage is also starting to show up in wage rates, with ANZ Bank reporting earlier today that Australia's wage price index rose by 0.6% in the March quarter, just above market expectations. The annualized rate was 2.